Welcome to Couples Creates Cash Flow, and this is Jordan Johnson, your host. Today, we're going to get into some really good math nerdery. We're looking at the 4% rule applied to the Vanguard Index Fund VOO, which is a very popular one to track the performance of the S&P 500. So if you don't know anything about the 4% rule, here's what it is in a nutshell. The idea is that if you amass an accumulated amount of money in an investment account somewhere, or all of them put together, that is 25 times your annual income, you'll be able to pull 4% out each year to pay your bills, to live off of, without having to touch the actual principal amount that you have invested. So today I thought, why don't we look and see how accurate the 4% rule would have been if we had decided to retire 5 years ago, and if we had already saved the amount of money we needed to reach that 4% rule accumulation number. So I looked at the historical performance of Vanguard, the VOO ticker symbol, and put all that together so that you can see what it looks like. So sharing my screen. On the left here, just so you see what I've done, I've got a monthly date, a price at the beginning of each month. I've got the dividend date, dividend amount, so I'm looking at this from the perspective of I would be reinvesting all my dividends. I would be looking at how do I use my dividends to buy more shares of VOO so that I can continue compounding the number of shares that I own. All right. And then I would also want to know how many, what the dollar amount would look like at any given time. So we're looking at 2018 from here to here. All right. And if we just look at the open price, we're starting at $258.29 a share. You can see that each month it goes down quite a bit, and then it comes back up. So that by the time we get to the end of the year, 257, and then it drops a little bit more in the January month of 2019 to 226. So the change from 226 to 258, or opposite, would be negative 12%. So in that year, if you had all your money invested, you lost 12%. Now over here, here's my invested amount. As you can tell, I'm not investing any more money. The idea was I took $100,000 in annual expenses, and I invested $2.5 million in order to cover the 4%, or this times 25. That would have been 9,679 shares at 258. So you can see how I did that. And then each quarter, there's a dividend. So in this case, we've got the dividend of 1.084, 1.157, and on and on. So what I've done is I've said, here's the total for that quarter, how much money, and then how many shares that would buy for that particular month, and then up the total shares to match that. So then at the end of this 12-month cycle, I'm showing that the dividends that you would be paid out for just owning those shares for that year would be 46,172 off of the 2.5 million. And I'm also showing that we need to pull out $103,000 for living expenses. Now, I said 100,000 earlier, but what I'm showing here is a 3% cost of living increase. So inflation or what have you. So we're pulling out 455 shares. So the price at 226, we're selling at the lowest point that we've seen so far. And spoiler alert, that is actually the lowest point in the entire model. So we're off to a really terrible start. We've lost 14% of our value. Our 2.5 million is now worth 2.1 after we pulled 103,000 out. So this is where you might despair and say, oh no, this model is not going to work. However, let's give it a chance. So we go back to the next year, 2019, this next 12-month period. We see that the price goes from 226 up to 248 the next month, which then is our new starting point, since this is February, or it's almost February of 2023. and I did my 5-year look back based on exactly 60 months. So the new 12 months starts on February of 2019, and we see a starting price of 248, and it goes up to, in that 12-month year, 297. So we've seen an increase of 19%. We've also seen that from 258, we got back to our starting point in, it took us about 15 months. Now we're at 297, and our dividend yield on the shares that we own was 52,000 for that year. We're pulling out another 3%, which is $100,000 plus our compounding 3%. So we have 106.90 that we need to pull out. This time, though, you'll notice that the shares are only 356 versus 455, and that's because our share price is a lot higher than the previous year. Not only did we make back what we were at the loss, we actually increased by almost $50 a share. So it does not take quite as many shares to get to that 106,000. And so our value is actually pretty stable. And if we look at overall, we're at positive 9.95%. Even after pulling out 700, 800 shares worth of stock. All right, pretty good. Now we're looking at 2020. We all know what happened in 2020. Things got worse before they got better. And we see here, April 1st, we've got another pretty low point, although not as low, actually. This actually was that Christmas Eve meltdown in 2018, and it was still lingering by 2020 or 2019 at the first of the year. That was quite the fiasco. Did bounce back pretty quick, though. This fiasco was the stock market going downhill pretty quick in the month of March. It ended up rebounding fairly quickly. You see, by the end of the year, we actually went up 25% from 297 to 345. Our annual dividend amount would have been 49,000, and our annual change was 16%. And now overall, we're up to 25% even after we sell another 316 shares to get our living expenses met. All right, so then if we go here to the next year, we've got 343 as our starting number, and it gets all the way up to 437, a 27% increase in 2021. And so it only takes us 257 shares to get up to our needed number. Another $49,000 in dividends. That's actually staying pretty stable, yeah, that first year it was 46, but then 52, 49, 49, and our share number is fairly similar. So we're looking at a total value of our portfolio, even after pulling out 1, 2, 3, 4 years worth of living expenses. We see our value went up to 3.9 million. So we are quite happy with a 56% yield. Okay, so then looking back to 2022, we did not do quite as well. We lost some of that value. So selling high at this point actually was really beneficial for us. We pulled our money out at its most valuable point in the whole scheme of things. And then we look at this last year, and it went down 14.76%, although our dividend value went up to 53%. So at the end of 60 months, in a look back, in a hypothetical situation, we went from 96.79 in total shares down to 87.74 in total shares. So we did sell off quite a few shares, 900 or so to be exact. And we increased the value of our holdings by 23%, even after we pulled out our living expenses 5 times. So this is why the 4% rule is a thing. It's because it works. If you look at these numbers, you can see that even in a 5-year period where we went down by 14 in one year and down by 12 in another year, we also went up by 19, up by 16, and up by 27. So obviously that helps. But you can see how the market volatility does not really affect the ability to pull living expenses out of this fund and have it still grow. We even had the unfortunate event at the very first year of having to pull out 455 shares just to cover our living expenses. So in comparison, that was almost twice. It was 200 shares more than we needed to pull out in the start of 2022 to get a similar number. So very tricky starting place here when you think about the shares and the dividends that go with it. Um, so this is a viable option when you're looking at the accumulation method. Now, what is the problem with this method? I just only have a couple concerns. The first concern is, what if you need to save 2.5 million and along the way you've got it invested and the amount that you have invested keeps going up and down? For example, if we didn't already have the 2.5 million invested and we were trying to put money away during a year where the value goes down by 12%, it's possible that we would be investing in a market where our value goes down before it goes up. And human nature would say people would give up at that point and they would have a really hard time staying invested. They would more likely take their money out and try something different that they think will pay better returns. But if you stay the course, you can see how it can actually turn out pretty good. The other thing I see is anytime you have to sell off an asset to pay your living expenses, even if you can do it without affecting the total value of the fund, I get a little nervous. So what I would look at actually is these dividends. So if you kept your 6,000 or 9,679 shares and you didn't end up selling them, and you just allowed the dividend reinvestment to continue, um, you could end up having your dividends create some money each quarter. Um, so that at some point you could just turn off the dividend reinvestment and just take the dividend checks. So then the question would be, can you live off of the dividend checks? The answer is probably not, right? $46,000 for expenses for the entire year might be a little too frugal for you, especially if that was your starting point. You would have not saved $2.5 million. You would have saved about half of that. So you would not have the dividend payout that you would in this situation. However, if you think about it, these dividends are basically paying out half of your living expenses for the year. So when you pull out the money, you're actually kind of pulling out about half as much. So that is actually kind of nice to know. Um, but it's different from a cash flow retirement plan where you're looking at like how many rental properties you have that are cash flowing a certain amount per month, because in the real estate world, you do not have to sell your real estate in order to pay your monthly expenses. You would just keep buying more real estate or paying off debt in a strategic way so that your cash flows from those investments would actually pay your living expenses without selling the asset. So that is the one big caveat I'll have to this model. It works. It does work. Um, and it can also mean you're selling off assets. But at the end of the day, even in a very volatile last 5 years, it did come out in a better place. Now, we cannot look at past performance and say that's what it's going to be like in the future either. That's the other thing. But we could look at this and say, even pulling out our shares, we averaged 4.5% of growth. We don't have inflation numbers factored in here either, because inflation has definitely gone up in the last couple of years. But even if inflation went up 10% and our yield is 13 or 14, we still did pretty well, right? We still ended up with having a good chunk each year. 3% growth after taking $500,000 out is pretty good. So that's your nerd update for the week. The 4% rule applied to VOO, and it looks like it works. So take that is however you want. Obviously, I cannot predict the future, and I do not want you to go out and invest a ton of money if it's not in a good place. You're not in a good place to do so. So this is only for education purposes, not for investment advice. So thanks for watching, and we'll see you later.